Hello friends, my name is Neetu and I'm an MBA finance student. I have started a new series, Finance, in which I will discuss many important concepts taught to the MBA students. Hope the material helps you and you can use this videos as a review before the exams. I will start my first topic in finance and the topic is financial management and the financial environment, an overview. Let's begin with the key terms. The terms will build the foundation for your upcoming topics. Proprietorship. Sole proprietorship is an unincorporated business owned by one individual. Its advantages are it is easily and inexpensively formed, it is subject to few government regulations, and it avoids corporate income taxes. However, all business earnings are taxed as a personal income tax to the owner. Its disadvantages are that it is limited in its ability to raise large sums of capital. The proprietor has unlimited personal liability for business debts, and it has a life limited to the life of the individual who created it. Partnership exists whenever two or more persons associate to conduct a non-corporate business. Its major advantage is its low cost and ease of formation. And the disadvantages are unlimited liability, limited life, difficulty of transferring the ownership, and difficulty of raising large amount of capital. A corporation is a legal entity created by a state and it is separate and distinct from its owners and managers. Its advantages are its unlimited life, ownership which is easily transferred through the exchange of stock, and limited liability. Because of these three factors, it is much easier for the corporations to raise money in the capital markets. Its disadvantages are corporate earnings may be subject to double taxation, and setting up a corporation and filing required state and federal reports are more complex and time consuming than for the sole proprietorship or partnership. A charter must be filed with the state where the firm is incorporated, and the bylaws which govern the management of the company must be prepared. The value of any business, other than a very small one, will probably be maximized if it is organized as a corporation. As the corporation grows, they face three issues. If the corporation continues to grow, it may become successful enough to attract lenders, or it may even raise additional funds through an initial public offering, IPO, by selling stock to the public at large. Agency problems can occur if the managers act in their own best interests rather than the best interests of the owners. Agency problems can be addressed by the company's corporate governance, which is a set of rules that control a company's behaviors towards its directors, managers, employees, shareholders, creditors, customers, competitors, and community. Maximizing the value of the firm should be the primary objective of the corporations. Value maximization means increases in owners' wealth achieved by maximizing the value of the firm's common stock. Free cash flows, FCF, are the cash flows that are available for distribution to all of the firm's investors, stockholders, and creditors after the firm pays expenses, pays its taxes, and makes the necessary investments to support growth. Three factors primarily determine the free cash flows. Number one, sales revenue. Number two, operating costs and taxes. And three, required investments in operating capital. Free cash flow is Sales revenue minus operating costs minus operating taxes minus required investments in operating capital. Managers can enhance their firm's values and stock prices by increasing the size of the expected free cash flows, by speeding up their receipt, and by reducing their risk.